Welcome to the deep dive. So you've handed us a stack of source material today, and it's dense. We've got financial outlooks, geopolitical risk reports, policy updates, all trying to frame the year ahead.
Exactly. And our mission today is to just cut through that noise. We're not here for a textbook reading. We're here to pull out the absolute core trends that are going to matter to you.
Right.
We need to figure out what the expectations are for 2026, where the real policy risks are hiding, and, most importantly, what this all means for your daily life, for your wallet.
Okay, so let's jump right into that big picture hook because it really sets the stage for the whole year. We are starting 2026 with equity benchmarks. We can track this with the S&P 500 ETF, and they are near all-time highs. 2025 was a massive year for growth.
It was huge.
So it set a very high bar. What was the final number we saw in the sources for the S&P 500 gain?
It came in at a substantial 16.39% rise in 2025.
Yeah.
And that's the third straight year of gains.
Wow.
I mean, that is just phenomenal performance. But here's the interesting part. Wall Street's expectations for 2026, they're surprisingly tempered. Despite all that momentum, the consensus right now is predicting modest to mid-teens gains.
Modest to mid-teens. If the market's running that hot, why isn't the forecast, closer to 20 or 25%? What's holding back that optimism?
Well, it's the continued belief in the AI engine, but there's a big asterisk next to valuation. The growth story is still solid. The sources repeatedly cite these massive ongoing AI investments from, the giants Alphabet, Amazon, Meta, Microsoft.
The usual suspects.
The usual suspects, exactly. The key drivers from last year are still the key drivers now. NVIDIA, Microsoft, Apple, Tesla, Palantir. These companies did all the heavy lifting in 2025, and they're expected to do it again. The optimism is almost purely about corporate earnings tied to tech.
Okay, so that story AI driving everything is pretty clear. But here's where the signals get, contradictory. And where we see the first real policy headache, we had that incredible stock performance, yet the U.S. dollar had a really rough year.
It did. The dollar, tracked by the UUP fund, fell about 8% in 2025. That's its worst year since 2017.
That is a huge shift.
A massive shift. And it's a direct consequence of what the market expects from the Federal Reserve. It's pricing in a more dovish pivot. So more rate cuts, and maybe even leadership changes at the Fed. A weaker dollar, it just signals a drop in global confidence about U.S. monetary policy. It's the first major crack in the market's otherwise rosy corporate outlook.
From the economic side, though, most economists seem to be mapping out a firmer 2026 overall. They're expecting inflation to moderate, maybe some targeted Fed cuts. That sounds great, especially with jobless claims dipping below that key 200,000 mark.
Right, they hit 199,000. So a very tight labor market, not a lot of layoffs. The macro picture looks strong, job growth is there, inflation is easing. But, and this is the critical point that connects right back to you, the listener, this is our core conflict. Despite all these positive signals, affordability remains a top, sustained concern.
That's the tension we see across all the sources. Market indexes are hitting records, but the average person is still feeling squeezed.
Precisely. Experts are urging people not to relax their guard. They're recommending budgeting, prioritizing savings, scheduling routine money dates throughout 2026. The good economic news just hasn't translated into widespread relief yet. We have this growing divergence between Wall Street's portfolio and Main Street's wallet.
And if consumers are worried about their wallets, even with record highs in the market, that must mean they're looking past corporate earnings. They're looking at Washington instead, right?
Absolutely. That consumer anxiety sets us up perfectly for this next piece on policy and central bank uncertainty. The market is priced for perfection right now, but the foundation is looking more and more fragile, mostly because of what's happening at the Fed.
Fragile is the perfect word. The December FOMC minutes came out, and they revealed this, unusually sharp split over that last quarter-point rate cut. Most officials wanted caution, but some apparently preferred to hold rates completely.
And that is highly significant for anyone watching the market. It signals that the unified forward guidance that markets crave, it's breaking down. The folks who wanted to hold rates, they're clearly still worried about inflation flaring back up. This division just means every future decision is going to be intensely uncertain.
And what's fascinating is how politics is just piling on top of that uncertainty. The source material notes that White House pressure on the Fed is set to escalate dramatically this year.
It connects directly to the whole question of independence. As President Trump narrows down potential successors to Chair Powell, and a name that keeps coming up is BlackRock's Rick Rieder, it raises this immediate, very serious debate.
Okay, so for the listener, why does a name like Rick Reeder, or really any major financial figure, being considered for Fed chair matter so much?
The concern is about blurring the line between fiscal and monetary policy. The Fed is supposed to be politically insulated, right? To make decisions based purely on data, even if the White House doesn't like them. A political appointment, especially from a huge firm like BlackRock, fuels this fear that future rate decisions could be influenced by political cycles or administration goals.
And that is a fundamental change in how the market has to calculate risk for 2026.
It is. So when you look at Wall Street's key risks for the year, what do they list?
They explicitly cite tariffs and Fed leadership uncertainty.
Exactly. Notice those are not corporate earnings or inflation metrics. They are political and policy risks. It confirms that politics and regulation are going to be just as important, maybe more important, than corporate earnings this year.
Let's pivot to a really concrete example of this. The sources call it the coal conundrum.
It is a perfect illustration of that security versus efficiency debate. The U.S. Energy Department ordered Craig Station Unit 1 in Colorado, which is part owned by Xcel Energy, to stay open past its scheduled retirement date.
The government just overrode their whole end-of-life plan. What was the reason?
Reliability. The DOE said it was necessary for regional energy stability. But the local detail here is the immediate pushback. Colorado officials confirmed this move could actually raise ratepayer costs because the plant isn't the most efficient option anymore.
So there's a direct, mandated clash. Regulatory reliability is overriding the free market's plan for efficiency.
That's it. And it raises this big question for the year. Who really dictates the lifespan of critical infrastructure? Is it the local utility driven by costs or a federal regulator driven by stability? We're going to see this tension everywhere.
Moving on to corporate shifts, 2026 kicked off with a huge one, truly the end of an era.
We're talking about the changing of the guard at Berkshire Hathaway. Warren Buffett officially retired as CEO after 6 decades. He handed the reins to Greg Abel.
How are investors taking that? The sources seem to suggest it's been pretty orderly.
It is orderly, and that's the key. Abel is an operations guy, and crucially, Buffett is staying on as chairman. He's still going to write his annual letters. Having his voice and vision still there is the safety blanket that's letting this all happen smoothly.
And from, the most established finance firm to disruptive media, we saw a really unique pivot from Trump Media and Technology Group, DJT.
Yeah, they announced a plan to distribute 1 crypto token per share. It's going to use Crypto.com and the Kronos blockchain. And the goal is to broaden engagement with perks tied to Truth Social. It's a novel strategy, trying to merge traditional stock ownership with Web3 loyalty.
So while all that was happening, there was finally some good news for the average consumer's wallet in the sources.
Absolutely, especially in housing and auto. Mortgage rates fell to a 2025 low of 6.15% as Treasury yields eased. That is fantastic news for the housing market and for lenders like Freddie Mac.
And for anyone buying a car, the IRS put out proposed rules for a new deduction, the no tax on car loan interest deduction for U.S.-assembled vehicles.
This is a huge targeted incentive. The intent is clear: support domestic manufacturing, so good for Ford and GM, while also making it a little cheaper for you if you choose a U.S.-assembled car. It's a policy win-win.
Before we hit our industry deep dive, we have to mention one really surprising closure that underlines that consumer spending point we made earlier. Sprinkles Cupcakes.
A very quiet end for such an iconic brand. After about 20 years, founder Candace Nelson confirmed it. It's a perfect, almost ironic anecdote, In a booming stock market, a premium discretionary brand that basically started the whole cupcake craze just couldn't make it work. Peers like Starbucks are fine, but it just shows how fragile that kind of spending is.
Let's jump into our industry deep dive now, starting with the EV race. The sources contrasted the staggering growth from 2 huge Chinese players.
The numbers are, frankly, mind-boggling, and they show what Western manufacturers are up against. Look at NIO. They delivered over 326,000 vehicles in 2025. That's a 46.9% increase year over year.
But Leapmotor was even more aggressive. They delivered over 500,000 vehicles, nearly 600,000, a massive 103% year-over-year jump.
And they're targeting 1 million annual sales in 2026. They're backed by state-owned FAW and Stellantis. So that aggressive state-backed expansion is the perfect lead-in to our next big issue, the geopolitical chip rift.
Right, because all those EVs need chips, and the supply chain tension is getting worse.
It's escalating between China and the Netherlands. Wingtech Technology, a Chinese company, owns the Dutch chip maker Nexperia. The Netherlands seized control of the company, citing national security concerns.
So Wing Tech is suing now.
They're escalating legal action. And when a country just takes control of a private chip maker, that's not just a business dispute. That is technology being used as a weapon.
Right.
So this fight risks major supply chain strain, especially for auto and industrial chips. It is a direct example of those policy risks we talked about playing out in the real economy.
Finally, let's look at healthcare pricing. Despite all this pressure from the White House on drug costs, Big Pharma is still planning price hikes for 2026.
That's the pattern. Drug makers like Pfizer and GSK are planning list price increases on at least 350 medicines. The median increase is around 4%. It just shows that broad political pressure often isn't enough.
But there was a counterexample showing where policy can work.
Correct. A few specific products, like Jardiance, are actually seeing price cuts. And this is explicitly because of the recent Medicare negotiations. It's the exception that proves the rule. Targeted legislated government intervention can shift pricing, even if the overall industry trend is still upward.
For our final segment, let's quickly hit Social Security and some regulatory notes. What's the COLA update for 2026?
The Social Security Administration announced a 2.8% cost of living adjustment, the COLA. But that benefit increase is going to be partially offset for some retirees because Medicare Part B premiums are rising to $202.90.
That's a key detail for millions of retirees and for insurers like United Health.
And on the compliance front, we saw the Colorado cannabis recall.
Right.
It involved vape and pre-roll products from CC brands over pesticide overages. It's just a sharp reminder that compliance risks are constant, even in highly regulated markets. Operators like Canopy Growth have to navigate this stuff all the time.
And before we wrap, just a quick bit of housekeeping. Remember that banks and markets are closed for the federal holiday, but major retailers like Walmart should be open, though maybe with adjusted hours.
Good to know. So don't show up at your brokerage, but you can probably get to the store.
So we've covered the whole landscape, and the core conflict for 2026 seems clear.
Yeah.
You have the market's enthusiastic belief in AI and growth on one side.
And on the other, you have these rising policy tensions, the divided Fed, political pressure, tariffs, the chip rifts.
Yeah.
There's a major contrast.
So what's the key takeaway for you, the listener?
It's this. You have to understand the difference between corporate enthusiasm and political headwinds this year. That consensus forecast of modest gains is fragile. Don't treat the policy debate, whether it's about the dollar or a chip seizure, as just noise. It's a fundamental market driver.
Yeah.
Pay as much attention to Washington and Beijing as you do to Silicon Valley.
Which brings us back to that specific example from Colorado. The DOE ordering a coal unit to stay online for reliability, even though it could raise costs for people there. Here's a final provocative thought to mull over.
What happens when the need for regulatory reliability or political security, whether that's guaranteed energy, guaranteed chip access, or an independent financial system, what happens when that clashes directly with the free market's pursuit of profit and efficiency? Which force is going to exert more influence over 2026? The political need for security or the economic pursuit of efficiency? That tension is what's going to define the winners and losers of the year ahead.